So welcome back everyone, and now we are going to start with the forward contracts delivery, cancellation and extension. This is the last topic, second last topic in your foreign exchange chapter, and this is going to be the last lecture in fact. So let's start with the basics. I will take the entire paragraph from the regular batch that I've discussed. Instead of writing each and everything, we are going to just discuss this thing, and don't worry about the concept. 100% of the concepts will be covered, sir. Have a look. So this is delivery, cancellation and extension. Understand, in order to hedge foreign currency exposure, we enter into forward contracts. So let's take from the angle of the export. Let's talk from the angle of the exporter and importer. So exporter and importer have this foreign currency risk, because the settlement or the receivable is to happen after 6 months or 3 months or some future date. And in order to hedge that risk, we enter into a forward contract with the foreign exchange dealer, which includes the bank as well. So we enter into a forward contract for hedging purposes. Okay, with the foreign exchange dealers, wherein we fix the exchange rate today for future settlement. Is that right? Yes, sir. In most of the questions previously, we have discussed this, that once we enter into a forward contract, that rate is fixed. That rate is fixed. That rate is fixed for the future settlement. And what happens at the maturity, at the end of 3 months, 6 months, 9 months, 1 year, we convert the foreign currency at that rate, the rate which has been agreed. Now, what happens in some circumstances? This was the story till now. In some circumstances, because of some uncertain or uncontrollable situation, honoring the contract on due date becomes impossible for the exporter and the importer. Now, what are those uncertain and uncontrollable situations? I will give you some examples. Let's say the customer to whom you paid, you sold the goods, went bankrupt. So he is not able to pay on due date, and you will not be able to honor the forward contract that you agreed with the bank. Let's say, for example, the production has stopped because of some strike or something, and that's why you are not able to deliver the goods on time to the customer, and that's why the customer will not pay you. Let's say, for example, because of some government changes in the exporters, or we can say the vendor's country, the production has stopped. That party is not able to supply the goods to us. We are the importer, and that's why the delay is there, and that's why we are not able to make the payment on due date. So there can be many practical situations which are uncertain and uncontrollable, and we resulting into non-honoring the contract on due date. Now what happens is that on this date, the start of the contract, the start of the transaction, you take the forward contract with the bank, and after this date, maybe on this date or due date, early date or due date, you realize that it is impossible for you to honor the contract, and that's why you want to first of all cancel the existing contract. Once you have entered into a forward contract, the only way to close that position is to cancel the contract by taking opposite position. So if you had agreed with the bank that you are going to buy dollars, now sell dollars. If you had agreed to sell dollars, now buy dollars. And both the transactions, the original one and the cancellation one, should expire on the same maturity date. Okay. Let's say, for example, 1 lakh dollar is receivable on this date, and now you are not able to make the payment to the bank or receive it from the bank. This type of situation can come into picture before due date or on due date, sometimes after due date as well, but that is considered as default. And thus we may want to cancel or extend the original contract. So in which situation we will be cancelling the contract? Let's say for example the deal between you and the other party has been cancelled due to some uncertain event, and that's why you want to cancel the contract. Let's say for example due to the production halt, the contract between you and the vendor has been postponed, and that's why you want to extend the contract, extend the settlement of foreign currency because of the delay in dispatch or delay in shipment or delay in production. Anything can happen. So there are two things that you may want to do. If you are not able to honor the contract on due date, you may want it to cancel or extend. Okay. In such a case, the FEDI rules will be applicable. FEDI is full form, sir. Foreign Exchange Dealers Association of India. Foreign, E for exchange, D for dealers, A for association, I for India. So FEDI rules are applicable, and there are lots of rules that you need to know for the Forex dealer, for the Forex transactions. So all in all, we are going to discuss about these 9 different situations. Now, we have divided the type of situation under 3 category and the timing of all this under 3 categories. So 3 into 3, 9 different situations will be there. So first of all, let's start with the simple part, delivery. You want to deliver the contract, or that means the foreign currency. So if you are exporter, you want to sell the dollars to bank wants to buy it. Okay, now you want to deliver, but the delivery can happen before due date, on due date, and after due date. Before due date, on due date, and after due date. In what circumstances before due date and after due date will be there? You remember that one question where we lagged the receivable by 1 month because we wanted to match it with the payables as well. $7.5 lakh and $7 lakh and $4.5 lakh receivables and payable question, and the question was whether we should cover the payables also in forward market, and at the end we decided that we should cover the payables also in forward market. So in that case, in the second option, we lagged the receivable, and once you lag the receivable by 1 month, that means you will deliver the foreign currency but after due date, after 1 month. So there can be different situations. Let's say for example, I will show you. The first situation is this. Contract, you enter into a bank contract with the bank on this date, and 3 months is the due date. Let's say for example 3 months is the due date. For exporter, there are receivable, and those receivable has to be sold to the bank. So bank, what will happen? The exporter will sell foreign currency to the bank on due date, and in that case we will sell the forward contract. So exporter will mostly enter into a forward contract if the base currency is the foreign currency. And in case of importer, he has a payable. That means he want to buy the foreign currency on due date, and that's why we will buy the forward contract today. Whatever we want to do with the base currency, we will do it with the forward contract. Okay. Now, so this is the due date on which you can consider any of the party. Like let's start from the exporter. So if you are the exporter, you want to sell foreign currency on this date to the bank, and for that purpose you entered into a contract with the bank. The very first and simple situation is whatever you agreed, you are delivering the foreign currency on due date. You are delivering the foreign currency on due date. That's the first and the simplest of the question. What will happen on that date? You are doing exactly as you promised. So the number of foreign currency multiplied by the rate will be your cash inflow and outflow. That's the first question to us. Have a look. We will go step by step. Every situation. See. On 1st June 2015, the bank enters into a forward contract for 2 months for selling 1 lakh US dollar. Understand that this is a bank who has entered into a forward contract, who will be selling the dollars to the customer. Imagine the customer is buying from the bank. The customer, why he will buy foreign currency? He will buy foreign currency only when he has to make the payment to some other party. That means he is importer. We are the bank, we are selling it. Okay. At 65.50 on 31st July, understand that was the 1st June. So entire June and entire July, that means this is the due date because 2 months was the due date. So on due date, the spot rate was like this. From our angle, we are the bank. Most of the time, these type of questions will be solved from the angle of the bank. If we are the bank, we have this spot rate. Calculate the amount to be debited to the customer's account. Debited to the customer's account. He will buy $1 lakh from us and pay rupees to us at an agreed rate of 65.50. And what is happening in this question is he is delivering the foreign currency. That means he is buying the foreign currency from us. We will give him $1 lakh and receive 65.50. So the bank will apply the rate originally agreed upon, which is 65.50, and will debit the account of the customer with this much of the amount. See, to the customer's account, he will get a credit of $1 lakh because he wants to buy it, and he will get a debit of 65,50,000 rupees. Debit means the bank has taken money from the customer's account. This is a simple question of delivery on due date. That means honoring the contract on due date. The importer agreed to buy the foreign currency from us and he is buying it on the due date. So it was this question. Whatever he has agreed, he is doing exactly the same. Simplest of the question. Now, what other options are there in case of delivery? There can be early delivery. See, he agreed to deliver the foreign currency or buy or sell the foreign currency on this date, but because of some certain uncertain situations, he want to deliver it before due date, 1 month before due date, 2 months before due date. So if the delivery is happening here, that means if the importer is buying foreign currency before due date or exporter is selling foreign currency before due date, we will call it as a early delivery. We will call it as early delivery. Delivery is happening, but it is before due date. So it will be called as delivery before due date or early delivery. Okay. This is delivery on due date, which is very simple. In that case, what happens is whatever the forward rate is applicable multiplied by the foreign currency or divided by the foreign currency as per the rates, that's the final answer. But what happens in the early delivery? This is one of the complicated situations. So we are not going to discuss it now. This is the 6th point of discussion. There are certain situations where it is impossible for you to deliver the foreign currency. That means to buy or sell the foreign currencies on the due date. Although you had agreed that you will buy or sell foreign currency on this date, but sometimes it becomes difficult to deliver it on due date, and that's why you deliver it after due date. So this is called as late delivery, because now you are late. If you are delivering at this point, let's say 1 month after due date, it will be called as late delivery. So all the three transactions are late delivery, early delivery, due date delivery. Delivery on due date, early delivery, late delivery. We will call it as early delivery. This is late delivery. Now this will also be discussed later at point number 7 after 6. Let's first discuss the second part now. Now what can happen? Cancellation. Sometimes you straight away want to cancel the contract that you have entered. And this cancellation can happen on due date, before due date, and after due date. See, if you want to cancel the contract on due date, it will be like on the same day you were expected to deliver the goods or the foreign currency, and now you are cancelling the contract. If the contract has been cancelled on spot, the spot rates will be applicable. This is the cancellation on due date. This is early cancellation, and you can see that you were supposed to deliver the foreign currency on this date, but now you are coming after the due date. So you are already late and then you are saying that you want to cancel. This is called as late cancellation. This is called as early cancellation. This is called as cancellation on due date. Okay. Now sometimes you want to deliver the goods, but you want some extension. Okay. But that opportunity that you will need some time can be communicated to the bank on due date, before due date, and after due date. So sometimes exactly on due date you will get to know that you are not able to deliver the goods or deliver the foreign currency on due date. Now you need extension on due date. Sometimes there is 1 month left for the delivery and you get to know that you will not be able to deliver the foreign currency on due date. That's why 1 month before itself you go to the bank and ask for the extension of the forward contract. Sometimes you make a default. You do not reach on the due date to the bank, and let's say for example you reach to the bank after 1 month of the due date. So you are late, you have defaulted, and after reaching to the bank also you are asking the bank to extend the contract. You want to honor it but you want to extend it. So all these cases which happens after due date are called as late delivery, late cancellation, and late extension. Sometimes you want to deliver on the spot but it's too late now. Sometimes you want to cancel the contract but it's too late now. And sometimes you want to extend but it's too late now. So 7, 8 and 9 will be discussed together. Before that we will discuss early delivery. So first discussion has already been completed, I think, and this is the simplest of the question, that you are delivering on due date. Now we are going to discuss the second and third part, that how to cancel a contract we have already entered on due date and before due date. See, so this is second and third. You will be cancelling the contract on due date and before due date. Now understand the logic of cancellation. Cancellation on due date, cancellation before due date. Okay, so there are only two things to remember in case of cancellation of the contract. Whatever contract you have entered into, the original contract, you have to cancel it by taking opposite position. Take opposite position to cancel any contract, and expiry of both the contracts should be same. See, if you enter into a forward sale contract, bank's angle, forward sale contract, that means you have to sell foreign currency of $1 lakh on this date. Now what happens is that on the due date, at the time of selling the dollars to the customer comes to you and he asks for cancellation of this contract. So first of all, you had a sell position, you will take opposite position in the same foreign currency. You had a sell position, you will take buy position. And this contract was expiring today itself. So the buy position will also expire today itself, that means spot buy. So the forward sale is also maturing today, spot buy transaction will also mature today. The expiry or the maturity of both the contracts, the original one and the cancellation one, should be the same. It should expire at the same date. So only two things to remember. First of all, whatever the contract you want to cancel, take the opposite position. If you have a sell, buy, sell. One thing. Second, make sure that both the contracts are expiring on same date. Okay, there is another situation I will tell you. Let's say you have sold the forward contract as it was in the previous part, and the delivery is 2 months from now. Delivery is 2 months from now. After reaching at this point, 1 month, after reaching at this point, you realize that you will not be able to honor the contract and now you want to cancel it. But still there is 1 month left to the cancellation or to the due date. So what type of contract will be entered by you on this date? Sir, very first thing is, if we have a sell position, take a buy position. If we have a sell position, take a buy position. Second, this buy contract should be maturing 1 month from now. 1 month from now. Why? Because we want to keep the maturity of both the contracts, the original one and the cancellation one, which at the same time, the maturity should be same. So if we enter into a spot buy contract, it will be wrong contract to cancel, because spot buy at the end of first month will be settled here itself. We don't want to settle the contract here. We want to settle the contract on the same maturity date as the original contract is. So only two things to remember: take the opposite position and make sure the expiry of both the contracts, the original and the cancellation one, is same. Let's do some questions on this. You will realize it. See, a customer with whom the bank had entered into 3-month forward purchase contract. See, bank had entered into a purchase contract. So it for bank it is purchase 3-month forward. So it's a 3-month forward buy contract for bank, and for a customer it's a 3-month forward sell contract. For Swiss franc 10,000 at the rate of 27.25. So basically, bank was supposed to purchase 10,000 Swiss franc from the customer at this rate. Comes to the bank after 2 months. See, the original time was 3 months, but only after 2 months he comes to the bank and request cancellation of the contract. On this date, the rates are prevailing as follows. Now understand. You will be better able to understand it from the time line. Okay. So this is your 3-month original contract, and let's talk from the angle of the bank. Bank had a buy contract, 3-month forward buy, and this was expiring at this date, right? So on this date the transaction was supposed to happen, and bank was about to buy 3-month, buy the dollars and pay the amount. 27.25 was the bank's outflow. So bank was about to pay 27.25 on this date. Now after 2 months itself, means on this date, we want to cancel this contract. So this was first of all buy contract. Let me just write it properly. 3 months forward buy contract. So we will first take the opposite position, which means we will enter into a sell contract. Now understand, if you enter into a spot sell contract, it will expire on this date itself. The objective should be the expiry of this contract and the new contract should be same. That means the cancellation contract should also expire at the end of 3 months. So it will be forward sell, because 1 month is still left for the due date. We will enter into forward sell contract with the customer, and this forward is only 1 month away from the due date. That's why we will go for 1 month. So it is like this: 1 month forward sell to cancel 3-month forward buy. Both of them are expiring on the same date. Now you are talking from the angle of the bank. So if the bank wants to sell in forward market for 1 month, ask rate will be used, which is this 1 month forward ask rate. So bank is selling, that means 27.52. Now you see that it's the loss of the customer and the profit of the bank, because bank is selling at a higher rate and buying it at a lower rate. Exactly opposite will be for the customer. Customer is buying at this rate and selling at this rate. Selling at this rate and buying at this rate. So 0.27. See, net amount payable by customer, because it's a loss to him. Original contract was 27.25. See, for the bank and for customer, 27.25 was payable by the bank and receivable by the customer, and 27.52 is receivable by the bank, payable by the customer. So ultimately we can see 0.27 is positive for the bank and 0.27 is negative for the customer. So that's why it's a loss. So 0.27 multiplied by 10,000 Swiss franc. 0.27 rupees per franc was the loss to the customer. That's it. The only thing to remember is the expiry should be same. Okay, come to the next question now. Question number 92. You as a banker, again you are a banker in this question, has entered into a 3-month forward contract with your customer to purchase. You are purchasing 3-month forward buy contract. This is the original contract. Australian dollar 1 lakh. So you can see that there is an inflow of Australian dollar against the outflow of Indian rupees. Okay. However, after 2 months, in this case also after 2 months, your customer comes to you and requests the cancellation of the contract. On this date, the quotation of the Australian dollar in the market is as follows. After 2 months, the spot rate is this and 1 month forward is this. Why we are going to use this? Because this will ensure that the expiry of the cancellation contract is 1 month away from today, which is exactly 3 months forward contract due date. So this is the contract. Determine the cancellation charges payable by the customer. It's very simple. From the bank's angle, bank had entered into a bank had entered into 3-month forward buy contract. Now, in order to cancel it, the very first thing is, instead of buy, enter into a sale contract. Now you have to decide whether it should be a spot sell or forward sell. One, two, three. This is the point where original contract is expiring, and understand that this should be the point where the new contract is expiring, and we are already standing at this point. So we will take 1 month forward contract, because we want the cancellation contract to expire 1 month from now, which is exactly the expiry date of original contract. So it will be forward contract again, but now this time it will be 1 month, because only 1 month is left for the expiry. So 1 month forward sell from the bank's angle will be 47.52. Sell contract means ask. From the bank's angle it's ask. Bank is selling, na? So bank's angle it's a ask rate 47.52. So you can clearly see that bank was paying 47.25 here. Bank will sell 47.50. So the selling rate is higher than the buying rate. Again, there is a profit to the bank and loss to the customer because of cancellation. 27 paisa. That's again 27,000 rupees on 1 lakh Swiss franc. Question number 93. Yes. Let's come to question number 93. See, this is a great question, and you can put this question only for the early cancellation. A bank enters into a forward purchase TT covering an export bill of Swiss franc 1 lakh. Now you need to understand first. The bank has entered into a forward purchase. That means bank will buy Swiss franc, customer will sell it. Why the customer will sell it? Because he is an exporter. He might have exported goods to the customer, and customer will pay him 1 lakh Swiss francs, and that client will come to us. We are the bank. That client will come to us to sell those Swiss franc. So he will sell it, we will buy it as a bank. And the rate that is agreed is 32.40. So once we buy as a bank, once we buy this Swiss franc, this is going to be our outflow. Buying means purchasing, cash outflow. Okay. Due on 25th April and covered itself for the same delivery in the local interbank market at 32.42. Now what happens most of the time is, whatever the bank enters into a transaction with you, they do the exactly opposite in the interbank market. So they don't keep their Swiss franc, keep the Swiss franc with them. They will take the Swiss franc from you at 32.40 and they will sell it to the other bank at 32.42, keeping a profit of 0.02. So this is how the transactions happens. However, on 25th March itself, now understand that this is just 1 month before the due date. This is just 1 month before due date. The customer is coming and asking for a cancellation. Now, if he is coming before due date, we need to enter into such a transaction that the cancellation contract also expires on due date. So we will have to take forward contract for cancellation. Okay, sir. And that too opposite one. Understand the situation now. The question numbers in this concept, now see, I'm putting this entire discussion of forward contracts from the regular batch in the fast track batch, right? So I'm just copying it and pasting it here. But what will happen is that in like between all this, the question numbers will also get copied. And I don't think so I will remove the answers of that. So these question number will not match with your fast track question numbers. So be careful about it. What I can do is, to the maximum possible, I can mark those numbers, like it's question number 90. So if I change it, it will be 90, like this. I can do it. I will try if I can do that. And this was question number 91. So this will be 91, then 92, 92, and now I think it's 93. And that's a good thing that everything is written here so that I can explain it to you in a better manner. Now understand the situation. This is us. No, this is us, this bank. Now what happened? Customer came to us. Customer might have exported goods to the customer. Customer means our customer and his customer. So exporter, let's say, exporter might have sold the goods to the customer, and for that purpose he was about to receive 1 lakh Swiss franc after some time on 25th April from this customer to the exporter, 1 lakh CHF. So exporter came to us and entered into a forward contract that I will give you 1 lakh CHF, you pay me rupees. So you can clearly see from the bank's angle, bank is agreeing to purchase, means receive this much of the Swiss franc and pay this much of the rupees. Now what happened is that bank got to know that on 25th April they will get CHF 1 lakh. They immediately entered into a contract with bank 2 that this 1 lakh CHF when received by the bank will be paid to the other bank at this rate. So you can clearly see that 1 lakh CHF will be received on 25th April and paid to the other bank on 25th April itself. So there will not be any foreign currency balance with this bank, but the cash outflow and inflow, they will receive 32.42 for each CHF, but will pay only 32.40, making a profit of 0.02 rupees on every Swiss franc. So that's practically 2000 rupees of the profit for the bank on the entire transaction. Okay, sir. But now what happened? This is the due date, 25th of April. Okay, this is the due date, and the party comes to the bank. The exporter comes to the bank on 25th of March itself, and he wants to cancel the contract. Understand that if he wants to cancel the contract, which has a due date of this, we will have to enter into a contract which is exactly opposite and expiring on the same due date. That is, sell forward for 1 month. The original contract was for the bank. For the bank, it was buy contract, forward, and 3 months. So let's say the forward buy contract is now getting cancelled with forward sell contract for 1 month. Original contract was 2 months forward buy. Cancellation contracts will be 1 month forward sell. And if we want to sell, we are a bank, we will take ask rate. If we want to sell the foreign currency, we will take ask rate. Now ask rate for the CHF INR is not directly given in the question, and you will have to use the cross rates for that. You can clearly see that. USD Swiss franc rates are given, USD rupee rates are given, but we need Swiss franc to rupee rate. Now when the bank wants to sell CHF, so a quote in which the base currency is CHF, bank will take the ask rate of that. So let's frame an equation. Let's frame an equation for ask rate of CHF INR. We will take ask rate of both CHF USD and USD INR. We will frame an equation in such a manner that this USD gets cancelled. But if we will look at the quotations given by the bank, it's not CHF USD, it's USD CHF. See, USD 1 Swiss franc this much. That means in ISO code it is CHF USD? No sir, it's USD CHF. USD is the base currency, CHF is the price currency. So we need CHF USD. We need a quote where CHF is the base currency, but we have a quote where USD is the base currency. What should we do? We will inverse that quote, and while doing that, ask will become bid. You can see ask will become bid, and these quotes will exchange each other's place. It will be USD CHF. The other quote required is USD INR, and exactly that is given to us, USD INR. So this is how we are going to solve. So we will take this rate, ask rate of USD INR and bid rate of this. But the question is how to calculate the ask rate of USD INR. There are two different things. We need 1 month forward. 1 month forward. Okay, clear? See, in the Singapore market, Swiss francs were quoted against dollar, and in the interbank market, US dollars are quoted against rupees. This is not interbank rate, this is interbank rate. What is the difference between this? This is a merchant rate that can be directly applied to the exporter, but this cannot be directly applied to the exporter because this is interbank rate. That means you will have to add or less the margin. Deduct the margin from bid and add the margin in ask to make it merchant rates. Calculate the cancellation charges payable by the customer if exchange margin required by the bank is 0.10% on buying and selling both. Okay, sir. Let's calculate the forward rate. How will you calculate the forward rate? This is 49.4302 and these are in ascending order. We will add them. So add them. 49.4302 plus 0.4100. See, I will just show you. 1 month forward merchant rates. 1 month forward merchant rate for USD INR 49.4302 4455. This is the spot rate given. 1 month swap rates are given here. We will add them because it is ascending in order. Okay, once we add them, understand that this is the bank's buying rate and this is the selling rate. So in buying rate, we are going to deduct the margin because the margin is cash inflow to the bank. This amount is a cash outflow to the bank because bank will buy CHF and pay rupees, and bank will keep the margin in their pocket. So this is a cash inflow in both the cases. But this is also cash inflow, this is also cash inflow. That's why we are adding the margin in ask, deducting the margin from bid. Now the merchant rate arrived is 49.704, 7904, 49.9154. You need the ask rate of USD INR. This is the ask rate of USD INR 49.9154. See, 49.9154. How did we arrive at this? Adding the premium and then adding the margin. Because it's a ask rate, we can add the margin in that. Okay. Now we will take USD CHF bid rate, which is 1.5150. See, USD CHF bid rate 1.5150. The very first question that will come to your mind is, sir, why aren't we adding premium or margin of the bank in USD CHF? So this is not an interbank rate. This is not an interbank rate. Margin is adjusted only in the interbank rate to make it merchant rate. Now, if this is a merchant rate directly given to us 1.5150, we will assume that the margin is already adjusted in that. Margin is already adjusted in that. So if we keep these prices 49.9154 and 1.5150, the ask of CHF INR comes to 32.9475. This is the cancellation rate. 1 month from now, and you are doing all this transaction by standing at this point, that after 1 month you want to cancel the original buy contract with sell. That's why you will take 1 month forward sell. So this is the final rate. Okay, let's come to the conclusion now. Cancellation charges. The original 2-month buy rate was 32.40. Let's have a look. See, 32.40 with the client, 32.40. At this rate, bank was about to buy the Swiss franc. This was outflow. From the bank's angle, it was a buy contract. Then they cancelled it with 1 month forward sell contract, 32.9475. How did we arrive at 32.9475? Have a look. This is the rate, 32.9475, calculated from the cross rate, and these cross rates have been calculated from this point. So take the spot rate, add 1 month's point. This is the forward rate, add margin if required, and this is the merchant rate. So you can clearly see that there is a gain to the bank and loss to the exporter. 32.94 is the selling rate for the bank and 40 is the buying rate for the bank. So bank is obviously receiving more money than what it is agreed to pay. And who is going to pay that more money to the bank? Exporter. It will be a loss to the exporter, profit to the bank. So these buys and sell, if you will say that, sir, selling rate is high, then why the profit is not written? So I will just clearly make it clear that this is from the bank's angle. So yes, profit is there, but to the bank. For the exporter, it's a loss. If there is a profit to one party, there will be a loss to other party. It's a loss to the exporter. Loss of 0.5475 rupees per Swiss franc, and the total contract value of the Swiss franc was 1 lakh in this question. So charges payable by the exporter comes to 54,750. That's the final question to you. I will talk about it later on. A lot of students will ask what happened to this rate, 32.42. I think we should discuss it later on, because unnecessarily this will make the question complicated. Or let me try to solve it. I hope, first of all, let's first complete the answer by the institute. So what did the institute do? They first calculated the cross rate to cancel the contract, and they knew it. Original contract is 1 month forward buy, and that's why, 2 month forward buy, and we have to take sell contract, forward sell contract for 1 month, and bank will be selling. That means ask rate is required, which is not directly given. That's why we have used cross rates. So this is the USD to rupees spot rate, added premium, added margin. This becomes the forward rate for this USD INR. So this is the rate, this is the rate. So this is exchange difference payable by customer, 54,750. Now you might ask this question, sir, what happened to the cover contract that bank has taken? The bank was about to earn a profit of 2,000 rupees. What happened to that profit? I will tell you. That profit is already included in 54,750. And the explanation of that is given here. This is bank 2. See, let's just take a moment to understand this concept. This is our bank. This is our bank. Now the original contract is this one, original contract. Exporter came to us and we agreed to buy, see, forward buy. We agreed to buy 1 lakh CHF after 2 months and pay 32.40, right? Now, because the exporter wants to cancel, we entered into a new contract with him for 1 month forward sell. So we agreed to sell 1 lakh CHF to him, notional. Practically, we are not going to receive 1 lakh, we are not going to pay 1 lakh CHF. Both of them get cancelled with each other on the same day. On the same day, we were about to receive it and about to sell it. So both of them get cancelled with each other. And while we are selling 1 lakh CHF to the exporter, the rate comes to 32.9475. 32.9475. So you can clearly see that 32.9475 is an inflow to us, 32.40 is an outflow to us. The profit is 0.5475 on 1 lakh, it's 54,750. Now this profit of 54,750 includes the profit that we would have earned if the contract would have been honored with the bank. See, I will tell you. If you take the difference between these two, the original contract was we will take CHF from the exporter and sell it to the bank too, and we will pocket 32.42. We will receive 32.42 from the bank too, and we will pay 32.40 to the exporter, making or resulting into a profit of 2000 rupees. Okay, sir. But what happened because of the cancellation? We agreed to sell the CHF. So this CHF which was about to cover here, we covered it here itself. So what will happen? We will have to, with the interbank market also, we will have to cover or cancel the contract. Since exporter cancelled the forward buy contract with us, we will cancel the forward sell contract with the bank on the same day. So we will also enter into a forward contract with the other bank in which we will buy CHF and the other bank will sell CHF. The rate comes to 32.9145. That you will have to calculate. 32.9145. Yeah. Ask rate. 32.9145. So this is an outflow. You can see 32.9145 is going, 32.4242 is coming. So we are receiving less, paying more. We are receiving less, paying more. So there is a loss to us for 0.4945. That's 49,450. This loss will be recovered from the exporter and it is included in this 54,750. Have a look. There are three parts of the loss that we have recovered from the customer. First, the loss on cancellation of interbank contract. We had an interbank contract. We also cancelled it because of the exporter and we faced a loss of 49,450. So who is responsible for this? Exporter. We will recover it from the exporter. Loss of a profit on original contract, 2000. So 49,450, 2000 rupees, and the margin. Margin is not a profit or loss, right? Margin was of 3294. You can just calculate the margin separately and you will get this value. And if you do the total of this, it comes to 54,744. 54,755, rounding out difference, that's it, equivalent. So yes, basically whatever we are recovering from the customer or the exporter, all our future losses and profits are included in that. So don't worry about it. We are only making sure that we are keeping the profit of 2000 rupees even when the customer is cancelling the contract. So we are taking 2000 rupees. We are also taking 49,450 from the customer because we had to suffer this loss as a bank and the exporter is responsible for that. Okay, sir. Quite, we can say, challenging question. This is early cancellation. The only thing to remember in case of early cancellation is that enter into such a transaction where the expiry of the cancellation contract is same as that of the original contract. Rest of the things will be followed automatically. So this is a cancellation before due date. But what happens on cancellation on due date? See, again the same thing will apply. Take the opposite position and make sure the expiry is same. On due date, the expiry is this only. So instead of forward contract, we will go for the spot contract. Original one is sell, take buy. Original one is buy, take sell. And then we will go for the spot contract. Because spot transaction will ensure the same day maturity. Okay, come to this point. See, on 15th January 2015, this is cancellation on due date. Okay. You as a banker booked a forward contract of US $250,000 for your import customer. If the customer is importer, he will buy the foreign currency from us or sell the foreign currency to us. It's very simple, sir. We are a bank. He is an importer. He might have imported goods from some vendor and he has to make a payment to that vendor. He will come to us to buy foreign currency. We will enter into a forward sell contract with him. Deliverable on 15th March 2015, which is 2 months from now. So what is the original contract? The original contract for the bank is 2 months forward sell. Okay. After 2 months, the bank will sell $250,000 to customer at this rate. So we are selling, that means this is a receipt to us. On due date, the customer requests you to cancel the contract. On this date, quotation for the dollar in the interbank market is as follows. Now you tell me, if you are cancelling on due date, what will be the new transaction? First of all, in order to cancel a sell contract, take buy. And since this is the spot or due date already, we will take a spot rate. So you can see this contract is expiring today. This is also expiring today because of the spot rate. So we will go for spot buy. Who will go for spot buy? Bank. Because bank agreed to sell, bank will agree to buy. If the bank will buy, bid rate will be applicable and this is the rate. 65.29. But this is interbank rate. This cannot be applied directly to the merchant. Understand that this is a bid rate. What will you do? Assuming that the flat charges of 100 rupees will be applied and the margin is 0.10%. Can I write it like this? 65.2900 less 0.10%. We are deducting margin from that. Why? Because margin is our cash inflow and 65.29, the bid rate, is an outflow. We are buying now, right? So 0.10. Let me just go to this point. 65.29 less margin. So we come to this point, 65.2247. And now I will just explain one thing to you. In forward cancellation, extension and due date, you need to follow one standard practice, which has been sometime followed by the institute and not followed by the institute. All the rates should be in multiple of 0.0025, nearest multiple of 0.0025. Whenever you cancel a rate, see what has been done here. So this is the rate 65.2247. They rounded it off to the nearest 0.0025 and it comes to 50. 25, 0.0050, 0.0075. That's it. And you can say 0.0100. It is like that. Nearest 25 tick size, 0.0025. So this is the rounded off value. Now understand, 65.2250. 65.2250. At this rate we will buy. So this is our buying rate. Bought from the customer at this rate, sold to the customer at the original rate. Still we have a profit. Who has a profit? Bank has a profit. So it's a loss to the customer. Amount payable by customer is 12 paisa per dollar. The total dollars are 2,50,000. Flat charges of 100 and 12 paisa on 2,50,000. This is the total loss, 30,100 rupees. That's the amount payable by customer. It's very simple. Cancelling on the due date. If you are doing anything on the due date, the spot rate will be applicable. If you are doing something before due date, forward rate will be applicable. And the purpose of both are the transaction should end on the same day. Same expiry should be there for both the transaction. So this was question number 94, cancellation on due date. Okay, sir. Now coming back to the concept sheet. We learned about the forward contract, delivery on due date. It was very easy for us. Cancellation before due date, before due date, before due date and on due date. We discussed about these 4 topics, and what we learned from these is only two things. First, take opposite position. To cancel. think from bank's angle. Second, expiry of original and cancellation contract should be acha. What we will do is expiry, just we will keep it short. Take opposite position to cancel, and expiry should be same. So this much you should keep in mind. That's it. Whatever is the original contract, take the opposite position and then expiry should be same. So in order to make the expiry same, you might have to enter into a balance forward contract for the rest of the period. Take the forward contract for rest of the period or spot rate. Okay, sir. Now we are going to start with the questions of extension on due date. What is the difference in cancellation and extension? It's very simple, sir. If this is the original contract and this is the due date, in cancellation, you straight away close the previous contract. This is original contract which was supposed to expire on this date. And in extension, what will happen? I will tell you, it's very easy, sir. It's very easy. Extension of the contract cannot be done directly. In order to extend the contract, you will have to enter into a new contract with the bank, and the bank will ask you for cancellation of the original contract first. And this will be cancelled either for the balance period if you are cancelling here, or either for this period if you are cancelling here. So there can be two different dates: cancellation before due date, cancellation of on due date. We will discuss about the late wala part later on. So in order to enter into a new contract or extend the existing contract, first cancel the original contract. So first step in this will be cancel original contract. And for this first step, you are going to remind yourself about these two steps, because in order to cancel the original contract, you are going to follow all the learnings of these 4 questions. And then second, take, buy or sell, whatever you want to do, new forward contract. Now, understand, you will buy or sell a new forward contract, but the expiry of the new forward contract should be such that it is expiring on the date you want to deliver. So for example, you wanted to sell foreign currency on due date. Now you want to sell it after 1 month. 1 month after due date, and you are coming to the bank on this date. So what will happen? You will have to buy a new forward contract for 2 months. You can see, like if you are coming to the bank for extension on this date, which is 1 month before due date, you will have to take a new forward contract for 2 months, because from this point 2 months are left for the new delivery date, or your desired delivery date is 2 months away. So you will buy or sell, sell 2 month forward contract. So let's say for example, the original contract was 3 month forward sell, and you are coming to the bank 1 month before due date. First of all, you will cancel it, 1 month forward buy. You cancelled the original contract, and you want the extension by 2 months or by 1 month only. So you will buy 2 months, you will sell 2 month forward sell contract. So let's say this was expiring on this date, and you will take it, this will be cancelled 1 month in a gap of 1 month, and this will be extended by 1 more month. So this was 3 month, this is 1 month, this is 2 month, because you want to deliver on this date, right? So 1 month for the original due date and 1 more month for the extension period, and that's it. So the transactions are same to cancel it. The only thing that will add is the new forward rate. The new forward rate. Okay, if you are coming on the due date now, in this case, if you are coming on the due date to cancel, let's say this is the early extension, right? This is the early extension. You are coming early, you are coming before due date for extension. But if you come on due date, what will happen? It's very simple, sir. If you come on due date, you will cancel this 3-month forward sell by spot buy contract, because it's the due date already. You will take the opposite position but on spot. And from this point you have 1 more month. So you will take 1 month forward sell contract. Okay, let's read the matter once again and move on. Extension on due date. See, 3-month forward sell contract. This is the original one, and it is expiring on this due date. And on this due date itself, you are coming to the bank, going to the bank and asking for extension. For extension, the very first thing is cancel the original contract. It's a sell, take buy. And because it's on due date, forward will be cancelled with the spot, because the maturity of this should be the same. And from this point, you want to extend the contract by 2 months and you want to sell it, because you wanted to sell it earlier as well. So 2-month forward sell. Again, you entered into such type of contract, but now for the balance period, 2-month forward sell. So we will take the rate. If this is from the bank's angle, ask rate will be applicable. But if you extend it before due date, what will happen? So let's say, for example, once again, 3-month forward sell contract, which is maturing on this date. Do you get that? And you are coming to the bank on this date, 1 month before due date, to extend the contract. And extension says that cancel the original contract first. You can clearly see that from this date, 1 month is still left for the original due date. So we will take buy for the sell and 1 month forward. So we will take a buy position for the balance period of the original due date, and the balance period is still 1 month away. That's why forward rate. If it is 0 days away, we will take spot rate. And from this date, you want 2 more months extension. 2 months extension from due date. So from due date, it will take another 2 months. And from today, it's 3 months. So you will take 3-month forward sell. Question might ask you an extension of 2 months, but it is an extension of 2 months from this date, not the date where you are standing. So 2 months from the due date plus 1 month which is still away will make it 3-month forward sell contract. So you will enter into again the same transaction. Things to remember: cancel the original contract. Cancel the original contract where you will take the position opposite, expiry same. Take the new forward contract for the new expiry date. Take the new forward contract for the new expiry date. That's it. Let's solve some questions. This is also an easy part, and I will show you. This is what exactly we are covering in this is point number 4 and 5. Till now we are done with the point number 1, the first question, and after that there were 3 questions on early cancellation. Last question, 4th one, was on this cancellation on due date. Now we are going to discuss some questions on 4th and 5th point, which is extension on due date and before due date. On due date, before due date. This is going to be question number 95. Let's have a discussion. See, an importer requests his bank, he wants to buy foreign currency. Importer requests bank to extend the forward contract of $20,000, which is due for maturity on 30th October 2010 for a further period of 3 months. So the original due date is 30th October 2010. He agrees to pay required margin money for such extension of the contract. The contracted rate was 42.32 and the dollar quoted on 30th October 2010, exactly the same day. That means we are on due date. it's already a due date. Today the original contract is maturing, and at the date of honoring the contract he is coming to the bank and asking for an extension. So the first thing is the original forward, what was the contract? If you want to calculate it from the banker's point of view, let's write it. First of all, he is the importer. He wants to buy. He might have entered into something like X month of forward buy contract with the bank, and the bank would have entered into forward sell contract with the customer. So this is the selling rate of the bank, 42.32, buying rate of the importer. Now in order to think from the angle of the bank, cancel this contract on spot today itself, we will take a opposite position, that is buy spot, and we are bank, we are buying, that means bid rate is applicable. Okay sir, the spot bid rate is 41.50 in order to cancel it. Margin money for buying and selling rate is 0.075 and 0.20%. This is bid rate. Margin is deducted from bid rate and added to ask rate. I think you are comfortable with this concept by now. So 41.50, and you can see we are deducting margin from the bid rate, and that to 0.075% for the bid rate. So the new rate that has to be we have to make applicable to the customer is spot buy rate, that means bid rate. So bid is 41.50, that is this, and it will come to this point, which will be rounded off to the nearest point 0025, which comes to 41.4700. Now this becomes the buying rate for the bank. Understand, selling rate is 42.32, buying rate is 41.47. The bank is at a profit. Who is at profit? Bank is at a profit by cancellation. So customer will be at a loss by cancellation. 41.47, 42.32, the difference in favor of the bank, or we can say cost of the importer. Profit of one party is the loss of another party, 17,000 rupees. So in order to extend the contract, the very first thing that you have to do is cancel the original contract. So what we did in the first part is cancelled the original contract, and then we will enter into a new forward contract with the customer, that is importer. So again the bank will enter into forward sell contract, that was the original contract, for the next 3 months, because from this date he is extending it for 3 months. So 3 months forward sell contract. Sell means for the bank it is ask rate. This is from the bank's angle. So ask rate. Okay, sell means ask rate, and this is the premium for forward, because that's the spot now. We have to first calculate. So 41.52 plus 0.93%, that will give you the forward ask rate. Why plus? Why not minus? Because it is in ascending order. Swap points, if are in ascending order, we will add it. Descending order, we will deduct it. 41.9061. Okay, this is just the interbank forward rate. But now we are going to add margin also in that. From spot to forward, this is interbank, this will also be interbank, and then from interbank to merchant we will have to add 0.20%. That comes to 41.9899, which will be rounded off to 41.99. Simple, 41.99. That's it. This is the new rate. When you take the ask rate, you add the margin. Premium, adding the premium depends upon whether the swap points are going up or down. If it is going up, we will add the premium for forward, or if it is going down, we will deduct it. And we are adding the margin here because of the ask rate. This is the ask rate. Simple question. Take this one as a homework. And in this case, please remember, in this question, everything is similar, but in this question, the forward is at discount. So you are going to deduct it. Exactly, this premium, this premium, here you will deduct the discount. And in this case also, in this case, no, this is the spot rate, won't matter. Yeah, you will deduct the discount. And in this case, the customer is exporter. So all the transactions are exactly opposite of this question. Original transaction by the exporter receives the foreign currency from his customer. He will sell the foreign currency. So he might have entered into forward sell contract with the bank, which is a forward buy contract for the bank. Original contract is forward buy for the bank, which he now wants to extend. And if he wants to extend, we will have to first cancel it. In order to cancel, we will take the sell position. Bank will take the sell position, and now we have to confirm whether the cancel or extension is requested before due date or on due date. If it is on due date, we will take the spot rate, because we have to make sure that the expiry is same. He agrees to pay the required margin money for such extension. See, this is 31st October. This is also 31st October. The entire story is same as the previous question, and we are going to extend the contract on spot. So this will be the spot cancellation. Spot sell. After entering into a spot sell, we will be able to cancel the original contract. Spot sell, that means this rate minus, now we are going to add margin in that. Spot rate 61.52 and the margin is 0.20. See, 61.52, the margin. Margin is the bank's money. They will keep it they will add it at the time you are using ask rate. They will deduct it if you use the bid rate. Okay. So this is the closest. And there is something wrong with the rounding off in this question by the institute. The closest is 61.6425, not 6400. It's 6425. So to that extent, the answer will vary. Now, this was the bank's selling rate. This is the bank's buying rate. Let me check once again. I think it's opposite. Yeah, that cancellation. Bank is buying at the time of cancellation, right? Bank original contract was bank's buying rate, and then cancellation is selling. So this is the cancellation. This is original. Original was buy and cancellation is sell. You can clearly see that the bank is buying at a lower price and selling at a higher price. So again, in this question, there will be a profit to the bank on cancellation and loss to the customer. The difference in favor of the customer, let me just check once again. Oh, I thought it is 62. So yeah, it is 61.64. So bank is selling at a lower rate and buying at a higher rate. In this case, due to cancellation, the bank is at a loss. The rates are in the favor of the customer. This is the bank's loss and it is in the favor of the customer. So this is first time while cancelling the contract, the bank will pay to the customer because the rates are in his favor. That's good. Now, the cost to the importer. So you have to correct this. This is the exporter. In respect of the extension and the rate of new forward contract. See, this is the exporter. He wants to extend it by how many months? Again, in this question, 3 months. So from the due date, he wants to extend it by 3 months. So the bank will again enter into a contract with the exporter for the next 3 months. So it will be 3 months forward buy for the bank and 3 month forward sell for the exporter. Think from the angle of the bank in these types of questions. Forward buy, that means this point minus this point, because we want to calculate forward rate, and minus margin because it's a bid rate. So all the points will get deducted. See, bid rate minus discount minus margin. You need to make sure that, and this is rounded off. Okay, let's come to question number 97. This is also extension on due date, and I think I should skip this question. If there is nothing new, I will do that. Yeah, take it as homework. Your export customer. If the customer is an exporter, please understand, he wants to sell the foreign currency to bank will buy it. So the bank's original contract is forward buy, and if on this date, means on the original contract was for 2 months, and after 2 months he is coming to the bank, that means again this is an extension on due date itself. On due date, if you want to cancel, if the bank wants to cancel, the buy contract will be converted to sell, and again it will be spot sell, because it's the extension on due date. On due date you only take the spot rate to cancel, because the original contract is maturing today itself. We have to cancel the contract today itself. Okay, so the original rate with the customer is 62.52. So bank was supposed to buy every dollar at 62.52. Now bank will sell it at spot 62.68, but we have to adjust the margin 0.10%, and this is ask rate. So 62.68 plus 0.10%, am I right? Margin, exchange margin is always bank's inflow, and it will be deducted from bid rate and added to ask rate, which comes to 62.7427, and rounded off to 62.7425. 62.7425. So selling rate is higher in this case. Bank will win, means bank will have a profit, customer will have a loss. 62.52 into around 22,268. Let's see the final answer. $62.72. Why 72? Now this was that question that I told you in the very first lecture, that by mistake institute had the larger number on bid side and the smaller number on ask side. Bank will always win. Bank will always buy at a lower rate. So in this question, this becomes the bid rate and this becomes the ask rate. So I will have to take 62.72 as the ask rate, not 68. So it will be 72 and this rate will be changed. Let me change this. Do you get that? By mistake in the spot rate itself, you can see in the forward rate it's properly given 62.64 and 74, but by mistake in the spot rate they have written higher number on the bid side, but in the answer they have taken properly that this is ask and the later one is bid rate. So please understand, you will always check once. This is the only question in which this has happened from the 112 questions. Okay, so 62.72 and that's 62.7827. That becomes 62.7825. 62.7825. 0.2627 is the profit to the bank, because the bank's selling rate is higher, and loss to the customer around 26,272. $62.7 7825, yes, and 52, 2625, 26250. Yeah, right. 62.52 minus 62.7825, that's 2625. Yeah, proper, that's just the 2625. So 26250 is the final answer, which is the profit. You can see on 1 lakh, this is the loss to exporter or a profit to. This is the cancellation charges which will be payable by the customer to the bank on extending the contract, because in order to extend the existing contract, this is not at all possible. You will have to take a new contract with the bank and the original contract has to be cancelled. So we cancelled the original contract and the charges are 26,250 on $1 lakh. Now what will be the new contract? See, the customer asked us to extend the contract by 1 month. Here, by 1 month. So what will happen? We will again enter into, exporter will sell us after 1 month, we will buy it. Bank will buy it. So 1 month forward buy contract is required. 1 month forward buy for the bank. This is the rate. 62.64, less margin of 0.10% because it is bid. 62.64 less margin because of the bid rate, and this is the 0.0, this is the total amount which is rounded off to 62.5775, nearest 0.0025, nearest 0.0025. Question number 98. This is early extension. Now all these questions were extension on due date. This question is nothing new, but only one thing will happen, that in order to cancel the contract, we will be, instead of taking spot sell, we will be taking forward sell. For the balance period of maturity, we will be taking a contract. Have a look. So let's say you are a banker, entered into a forward purchase contract. So for you as a banker, it's a forward buy. This is original contract. Let me write it here. Okay. So what are you going to do in order to cancel it? If you want to cancel it, you will go with sell. But whether it is forward sell or spot sell depends upon the date of extension. When do you want to extend? $50,000 on 5th March with an export customer for 3 months. From March it is April, May and June at the rate of 59.60. 59.60. So this was the buying rate for the bank, selling rate for the customer. Because he is an exporter, he is going to sell the foreign currency to us. On the same day, you also covered yourself in the market at 60.6025. See, I already told you, whatever the loss will happen to bank in the interbank market will be covered under this cancellation charges. Don't worry about it. Don't worry about it. I will just show you in this question that how the cancellation taken from the customer includes the profit lost by the bank, loss in the interbank market and everything. However, on 5th May, that means 1 month before the due date. Let's write it. Question number 98. I will just go through the question if we have solved it already. The rates are 59 point something, so it will be easy for me to find out. 59 point something. See, so that's question number 98 for us. Yeah. See, on March, the bank has entered into 3-month forward buy contract. The delivery date is April, May and June. The original contract is expiring here, but on May itself, the customer came to the bank and asked for an extension on May. That means first we will have to cancel this contract. In order to cancel the buy contract, we will take sell contract first. And from this date, The original contract is still 1 month away. So we need to take such a contract of cancellation which also expires on the June. That means which is 1 month away. So 1 month forward sell is required. Sell because it is buy in the original contract, forward because we are still 1 month away. So 1 month forward sell by the bank. Bank will sell it. This is all from the bank's angle. Bank will sell it, so ask rate will be taken. Bank will sell it, so ask rate will be taken. So this way, with these two rates, the original contract will get cancelled and the new contract will be entered. The new contract will also be forward buy. Don't worry about it. But for how many months? From this date to the new expiry date. And question says that 1 month's extension is needed to the customer. 1 month's extension from June. But from May, it comes to 2 months. 2 months extension. So the question might be little tricky, that question will give you 1 month's extension. That the customer needs 1 month extension and you will end up buying 1 month forward buy contract. That will be wrong. That 1 month extension was requested from the due date. And now you are standing before the due date. 1 month before the due date. So 1 month that, 1 month this, and 2 months forward buy is required. This is from your angle, bank's angle. So bank's buying rate is bid rate. If you have to adjust the margin in this, you will add the margin in ask, deduct the margin in bid. Okay. Swap point depends upon the ascending or descending order. Let's do the calculations. First of all, we will sell 1 month forward so that we can cancel. 1 month forward sell from the bank's angle. 1 month. This is spot. After May, this is June. So this is 1 month forward because we are standing at May now. From May, June is 1 month away, July is 2 months away. So bank's selling rate. This. Am I right? 59.2425. And understand, is there any margin? Assuming a margin of 0.10% on buying and selling. So you have picked ask rate. In ask rate, we normally add the margin plus 0.10%. $59.3017 rounded off to 59.3025, nearest 0.0025. So 59.3025. Now you understand, you take this into consideration from the bank's angle. Bank is selling at a lower rate and buying at a higher rate. So it's a loss due to cancellation to the bank and profit to the customer. That's a good news for the customer, that because of the cancellation he is making some profit. Okay. Anything else? Come to this point. Original contract was forward by 59.6. Oh, that's wonderful feature. That's good. Cancel the contract with 1 month forward sell. So 59.2425 plus margin, because this is an ask rate. 59.2425 is a ask rate. So 59.3017, the closest rate is rounded off to 59.3025. Now you are going to take the difference between these two. It will be 0.2975 loss to the bank. You can clearly see which is the charges payable to customer. How much? On $50,000, 14,875. So that's the end of the story. Now, new forward rate. From this point, you will take 2 months forward buy. Bank will enter into a 2 months forward buy. So bank's bid rate, 2 months. This is the bank's bid rate, 59.63, but it is a bid rate. We are going to deduct the margin from that. Okay, sir. Six three now. Yeah, this one. So 2 months forward buy, interbank rate is 59.63, less margin you can clearly see 10%, and we will come to this point 59.5704 rounded off to 59.57. That's it. So this is the new rate. Now I will show you what happened with the bank. From the bank's angle, what happened to that cover rate that the bank had entered into, that is for 60.6025. You might ask this question because from the previous two questions we were ignoring this cover rate and there was no need to, that's why we ignored. So practically speaking, the bank will also cancel his contract or its contract in the interbank market. First, in the original transaction, bank thought that we will buy it from the customer and sell it in the interbank market. Now the customer is coming to us to cancel the contract between the bank and the customer. So we will do whatever is required with the customer to cancel the contract, but this contract with the other bank is open for us. We are the bank and we have entered into a cover contract. We also have to cancel this. Now understand, from our angle, we had a buy contract with the customer, we had a sell contract. In cover market or interbank market, we had a forward sell contract, and now the rates has to be taken from the other bank's angle. Understand, because it is between the two banks. Whenever the things are between two banks, the rates has to be taken from the or interpreted from the other bank's angle. Now we had a forward sell contract. In order to cancel it with the other bank as well, we will take a forward buy contract for 1 month. We will buy, the other bank will sell, the rate will be this much itself. So ultimately the same rate is going to be finalized. Let's do it. I will just show you. So 60.6025, at this you were selling, and 59.2425, at this you will buy from the interbank market. And please understand, when a bank deals with the other bank, there is no place for this margin. This margin is applied only when a bank enters into a contract with the client, not the other bank. So I'm not going to adjust margin in this case. Okay, sir. You can see that when we are cancelling our contract with the other bank, we are making a profit. 60.6025 minus 59.2425. So that's a profit of 1 rupees 36 paisa on every dollar. The total contract was for $50,000. So when our bank is cancelling the contract, we are making a profit of $68,000. Rupees. Right? Practically speaking, this is because of the customer. If there is a loss in the interbank market rate because of the customer, we say that we should recover it from the customer. But if there is a profit in the interbank market because of the customer, it should be paid back to the customer. That's what the FedI rules are. If the bank is earning some profit because of the customer, it should be paid back to the customer. But just wait. Because the customer is cancelling the contract, bank is losing on its own profit with the customer. It would have purchased from the customer at this rate and sold at this rate. So there is a loss of profit in this cancellation. So this is the profit on cancellation in the interbank market, and the loss on profit will be adjusted out of 68,000. Bank would have earned 60.6025 minus 59.60. That's 1.0025. The difference between these two is 1.0025 on $50,000. It will be. So bank is practically losing 50,125 rupees if the contract gets cancelled. So this loss of profit will be adjusted in this interbank profit cancellation. So 68,000 minus 50,125. Out of the profit of 68,000 in the interbank cancellation contract, the bank will keep its own 50,125, which it would have earned if the customer would have honored the contract. but he didn't honor it. So this profit will be recovered from this profit, and the balance will be paid back to minus 68,000. Sorry, 68,000 minus 5125 comes to 17,875. Okay, I think the rest of the amount is because of what is the total profit? 14,875. Okay, let me just check. This is the balance left with the the bank, and 14,875. That means around 3,000 rupees of margin difference will be there, but 3,000 is too much. Let's see if it is really 3,000 or what. I have the details here. See, this 14,875 paid to the customer. Profit of the bank by cancelling the interbank covered contract, it was 68,000. Cancellation of interbank contract, we bank earned 68,000. The profit of the bank if the customer would have honored the contract, and this is the margin. I told you the 3,000 rupees is around the margin, because with customer we have added the margin 0.10%. We adjusted the margin with the customer, but not in the interbank market. So this is how we have bifurcated 14,875. What I want to show you with this explanation is that whenever we recover or pay anything to the customer, whenever a bank recovers or pays anything to the customer, then the bank's interbank charges, this bank's interbank transactions profit or loss is recovered or already adjusted in that. So you should not get worried about what will happen to the cover contract of the bank in the interbank market, because if there is a profit there in the cancellation, it will be passed on to the client. If there is a loss to the bank because of the customer, it will be recovered from the client, and it is always included in this amount. So need not be worried about it. Okay, sir. Let's move on to question number 98, 99. From 99, we are going to shift to the new topic. Now, let me just take you to the original table. See, we have completed the delivery on due date. We have completed the cancellation on due date and before due date. We have completed the extension on due date and before due date. 1, 2, 3, 4 and 5. Okay, let's discuss what happens on due date. Whatever the rate has been agreed between the bank and the client should be honored. So apply that rate. What happens in the cancellation? Only two things to remember. First, take the opposite contract to cancel and make sure the balance, make sure the cancellation contract is expiring on the same day as the original contract. So take the forward or spot accordingly. Then comes the extension. Please understand the extension is not possible even though if it is written, even though if the customer is coming to us. So if the customer goes to the bank for extension of the contract, the bank will ask him to cancel the original contract first and enter into a new contract. So practically we are again doing the same thing that we did in the cancellation part, and taking a new rate is easy. For the balance period, we are going to take the new forward contract with the client. So 1, 2, 3, 4, 5 is easy. It was an easy part. Now 6th and 7, 8, 9 will be the most difficult part, because there are some additional rules in this case. One thing which is called as swap loss or swap gain will be introduced here. I will take a break and I will be back to discuss early delivery with the concepts. See you.